Hello, my fellow stock market jobbers and my stock market jobber community. My name is Mark. I am the stock market jobber. Let's see how many times I can say stock market jobber within 10 seconds. I think we're up to 4 by now. But anyway, let's take a look at the markets. Not necessarily a trading recommendation, but a way to come up with trading ideas. And the best traders let the market tell them what to do. They don't get their ideas from some pundit or some chat room or what have you. Now, first thing we look at is the S&P 500. Now, this ETF, it's called SPY because the symbol is SPY. It's an ETF or an exchange traded fund that is designed to track the S&P 500. If the S&P 500 goes up, it goes up by the same amount in terms of percentage. If the S&P 500 goes down, it goes down by the same amount of percentage. You get the idea. The S&P 500 is the most important index or benchmark on Wall Street. And when I say benchmark, the reason why I say that is because in the institutional trading world where I come from, where I spent more than 2 decades, money managers need to be rated against something. There's got to be a way to say whether they're good or not. And if they're compared to the S&P 500, well, if the S&P 500 is up by 10% and they're up by 12%, they're doing a good job. If they're up by 8%, they're doing a bad job. So anyway, this is where we start. I kind of call it the mothership, and then we work our way down. There's consists of 11 sectors, and those sectors consist of industries. Like for example, in the financial sector, there's the banking industry, there's the insurance industry. But let me just get into this right here. So here is SPY, and we are overbought and at resistance. Now, what does overbought mean? Overbought means something has been aggressively bought. The vast majority of time, a market will be trading in its what would be its typical or historical trading range. If we get above that, we call that overbought. Why is this important? Because overbought conditions will attract sellers into the market because they will be expecting a reversion to the mean. Now, you can see we're at this level that was resistance before. 408, it was resistance here, it was resistance here. Overbought markets that get to resistance tend to sell off. So there's a good chance we see some kind of a reversal. What is resistance? Resistance is a large collection of investors who are trying to sell shares at or close to the same price. If a market's going higher, it's because there's not enough supply to fill all the demand. In other words, there's not enough sell orders to fill all of the buy orders. So the buyers are going to need to have to pay a premium to get sellers off of the sidelines and to bring them back to the market. This forces an uptrend. When we get to resistance, well, the tide turns. All of a sudden, there's enough supply or sell orders to fill all of the demand or buy orders. So things tend to stop going higher or at least pause or reverse when they get to resistance. Now, why is there resistance at 408? Well, back here there was resistance. As we could see, the market's going higher. Yes, the resistance sells off. Then this resistance somehow mysteriously turns into support. You see that? 408 here becomes support there. What is support? Support is the opposite of resistance. It's a large group of investors who are looking to buy at or close to the same price. In this case, 408. When a market is going lower, there's not enough demand to absorb all of the supply or enough buy orders to take in all of the sellers. So the sellers are forced to offer their shares at a discount if they want to get buyers off of the sidelines. It's the exact opposite of when a market is going up. And we could see this now. Why would a level that was resistance here convert into support here? It seems kind of amazing, but it's true, and you can see this on a lot of charts. Resistance becomes support. Well, there are a lot of investors who sold here who regret doing so once the price went higher, and they tell themselves, I made a mistake. I'm going to buy my shares back, but I'm only going to do so if I can get them for the same price I sold them at. So if we have enough of these remorseful sellers placing their buy orders at the level that was resistance, it becomes support. And that's what happened here for like a couple of weeks. Now, we have the opposite. Support turned into resistance. How could support become resistance? Well, it's because of buyer's remorse. Investors bought The price goes lower. A lot of them tell themselves I've made a mistake. I want to get out, but I'm only going to do so if I get out at break even. So I'm going to place my sell order at the same level that I bought at. If we have enough remorseful buyers placing sell orders at the level that was support, support can turn into resistance. So now we're right back up to this resistance level, and we're overbought. Well, what does overbought mean? Like I said, the vast majority of times something trades within its historical or typical range. When we get aggressively bought and get above that, that is called overbought, and it draws sellers into the market. This red line here, it's called the Bollinger Band. This red line is 2 standard deviations above the 20-day moving average. Now, why is this important? Well, statistics tells us that 95% of all trading should be within 2 standard deviations of the mean. So if we get above this, it shows overbought conditions, and this brings sellers into the market. They're expecting a reversion to the mean. So we have a market that's at resistance, where there's a lot of sellers working around, and it's overbought. That's going to draw sellers into the market. So overbought markets that get to resistance tend to sell off. So I'm not saying the market is going to crash or anything like that, but if you're a short-term trader, you might want to think about maybe lighten up your load here, maybe taking some short-term profits. I get a feeling we're going to get a little bit of a correction. The S&P, or the SPY, is 11 sectors, and here they are. Information technology, healthcare, financials, discretionary, industrials, staples, communication services, energy, utilities, materials, real estate. The market is the sum of its parts, right? It's like a puzzle. And if you examine what the different sectors are doing, it could give you insight into what the market is going to do. Just pretend you went and you wanted to buy like a new car. The thing looked really beautiful. It was shiny. You like the color. You like the design. But then you opened up the hood and you saw like it needed a new transmission and things were rotten out. Well, you might get the sense that, gee, this car is going to go down in value. Well, by looking at the different sectors, we can kind of get insight into what's going to happen within the market. Sometimes different sectors are in the driver's seat. It changes. Sometimes healthcare is what's driving the market. Sometimes it's tech. And when I say driving, think about this, right? It's never this easy in the real world, but just to be hypothetical, pretend every sector is flat, it's not moving, with the exception of industrials, and that's been moving higher. Well, these sectors are what constitutes the S&P. If industrials are going higher and nothing else is, well, the market's going to be going higher because industrials will be pulling it higher. Now, let's just say that industrials get very overbought and get to resistance. There's a good chance they're going to reverse. And if they're the only sector that's been driving the market higher, there's a good chance the market is going to reverse. So we look at these pieces of the puzzle. Different things are in the driver's seat at different times. Materials, real estate, they're so small, utilities, such small percentages. They don't typically influence the broader markets, but we can watch utilities to get insight over interest rates. Energy, it's not even 5%. Believe it or not, when I first started doing this 25 years ago, this was the biggest sector. But energy influences all industries, so we can get some insight there. All right, so let me get going on here. I know I'm rambling already. Here's our tech sector. Overbought. Okay, now this is different. This is not what we call Bollinger Band. This is the relative strength index. It's a different way of measuring momentum. And when this blue line gets up to the red line and indicates overbought conditions, remember, overbought conditions can draw sellers into the market because they're expecting a reversion to the mean. Now, here we have resistance, and it became support. Sellers remorse. Investors sold. When the market went lower, they thought they did a good job. The price goes higher. They tell themselves, I made a mistake. I am going to buy my shares back, but only if I can get them at the same price I sold them at. So if you have enough remorseful sellers placing buy orders, resistance can become support. And that's what happened here. So this is bullish. As long as this 144 level stays support, it could be setting the stage for a new move higher. We're overbought, we're at resistance, so there's a good chance we see a little bit of profit taking. And again, I don't think the market's going to crash or anything like that, but we're overdue for some selling, we're overdue for some profit taking. Why is there resistance at a level that was resistance before? Well, let's go back to psychology. You can only understand a chart if you look at it through the context of supply and demand and investor psychology. There were investors who bought back here who regretted doing so when the price went lower. They say, I made a mistake. I'm going to be patient. If this thing ever gets back to where I bought it, I'm going to sell. So you have remorseful buyers placing sell orders at the level that was resistance. If there's enough that converts, it becomes resistance again. Technical analysis has a bad reputation, and I can see why. There's so many technical analysts out there that just really don't know what the hell they're doing. They try to find these patterns on charts without really understanding what they mean. Even worse, you got these analysts that promote these, farcical techniques like Gann theory and Elliott wave and Fibonacci. I mean, that stuff is all science fiction, at least in my opinion. No one in the institutional trading world looks at that stuff. But anyway, resistance becomes support. Think about this. Psychology. Why would resistance become support? Psychology. Seller's remorse. Why would resistance become resistance again? Psychology. Buyer's remorse. Here's our healthcare sector, and once again, we could see it's overbought. It's above this red line, right? It's more than 2 standard deviations above the average, and we got to a level that's probably resistance. Support here was resistance there. Buyer's remorse. Investors bought, price goes lower. A lot of them tell themselves, I made a mistake. I'm going to buy my shares back. I'm sorry. Investors bought, price goes lower. They experience buyer's remorse. They tell themselves, if I can get out at break even, I'm going to. If you have enough remorseful buyers placing sell orders at the level that was support, it turns into resistance. And that's what happened here. And now it's resistance again, and it's overbought. Overbought markets that get to resistance tend to sell off. So between tech and healthcare, that's about 40% of the market. So that's I don't guess. I let the market tell me what to do, and so do all of the other best traders. Or I should say successful traders. Now look at this. Here's our financial sector. Has it really recovered? Has the banking sector really been saved? I don't know. This action is not that convincing to me. But we can see a clear example here of what I was talking about. Resistance becomes support. Support becomes resistance. If you don't understand that what we're looking at is a graphical illustration of investor psychology, you will never be able to read a chart correctly. Maybe you'll make money, but you're probably just getting lucky. If you really want to know how to do this, you have to be a member of stockmarketjobber.com and learn from someone who has been around the block a few times. You don't need to be a chart guru or a former hedge fund trader. Look, market goes up, hits resistance. Market goes down, finds support. Market goes down, finds support. Market goes up, hits resistance. Knowing where these important levels are is one of the most important things about trading. The best traders pay attention to not strange, esoteric, farcical things like we talked about. They pay attention to what are the important levels, what are the important trends, what is the momentum, what is the psychology. It's not as complicated as a lot of people make it out to be. Wall Street makes things out to be complicated because they can charge more fees. Wall Street seems complicated because most of the journalists or analysts really don't know what the hell they're talking about. Very few of them do. I mean, I don't even pay attention to the news or chat rooms. There's 3 stages of a trader. The first stage is they want to be told what to do. All right. They lose money. The second stage is they think they can come up with some infallible system. They lose money. The third stage is when they start making money, and very few investors actually get to this. The third stage is when you start to realize it's about psychology. And what does psychology do? Psychology determines which price levels are important. Psychology determines what the trend is. Psychology determines whether something's overbought or oversold. Doesn't have to be as complicated as you probably think it does. Now look at this, clear example. Resistance becomes support. Support becomes resistance. Now maybe we've broken through. A breakout is when we get above resistance. And once again, we got to look at it in terms of psychology and um, supply and demand. And I hate to like kind of kick a dead horse to death, but if you want to be successful, this is what you have to pay attention to. Look it up here. Support became resistance. Overbought markets that get to resistance tend to sell off. Buyer's remorse turns support into resistance. It was overbought. That means investors are aggressively buying it to the point where they're too aggressive. That's psychological, okay? It's like, oh man, I'm just going to throw caution to the wind and go out and buy it. So we have resistance, became support. Now this is what we call, potentially could be a breakout. A breakout is when we get above resistance. This tells us something. It tells us that the investors who created the resistance with their sell orders may be out of the market. And when sellers come out of a market or you take supply out of a market, it sets the stage for the demand side to push the price higher. Or the sellers are going to have to be willing to pay, the buyers are going to have to be willing to pay higher prices if they want to get shares. But sometimes we get these reversals, so there's just something else to watch here. We got important levels, testing resistance that are overbought. Tells me that the market's maybe not going to have a big sell-off, but there's probably going to be some profit taking or some consolidation. Clear resistance around 103.50 for industrials, clear support. Now, one thing you might notice is this. Notice how when we get to resistance and we don't get through, we get these kind of rapid moves lower. Well, think about this. There are investors who are trying to sell, right? They're the ones who create the resistance. All of a sudden, a lot of them notice, oh, gee, the market's not moving any higher. The price isn't going up anymore. What's going on? Well, maybe there are other sellers lurking on the sidelines. So I don't want them to undercut me because the buyers are going to go to who's ever willing to sell it at the lowest price. If I'm at 103.50 and someone else is willing to sell at 103, well, that's who the buyers are going to go to. So they might tell themselves, all right, well, you know what? Someone else went to 103, I'm going to go to 102.50. Someone else sees that and they're like, I'm going to go to 102. It creates a snowball effect. Market psychology. We come off a resistance. Because of psychology, we get this snowball effect. Support is the opposite. Investors may want to buy at 97. Some of them notice, oh, gee, the price isn't going any lower. That must mean that there are other buyers around. I don't want to miss out. I got to be willing to pay the highest price in town because if someone's willing to pay a higher price than me, that's who the sellers are going to go to. So buyers start getting ahead of each other and it causes a snowball effect. Right? There's no reason for these moves other than psychology and perception. If you listen to the media, Fox Business News or CSNB or MSNBC, CNBC, they just try to give every little move a fundamental reason for it. It's COVID this, it's Taiwan that, it's Ukraine this. The vast majority of the time, the reason why the market is moving is because of investor perception and psychology, and that's it, okay? If you don't understand this, you're not going to be able to understand how to trade. So I'm glad you're here at stockmarketjobber.com because you obviously want to learn. And people who want to learn are the ones who become successful. Resistance here, look at that, within 50 cents. Resistance here, resistance here. There's a good chance there's going to be resistance here for the reasons why we discussed. Remorseful buyers trying to get out at the same price they bought it. Here we have support becomes resistance, resistance becomes support. Again, you don't need to be a market guru to see that. Some price levels are more important than others, and that's what good traders pay attention to. What are the important price levels? An important price level is like a fork in the road. When a market or a stock or whatever you're trading gets to an important level, they tend not to hang out at them for too long. They tend to break one way or the other. They either reverse or break through. All right, let me move along here. This is ready to become way longer than I thought it would be, but whatever, man. I like to teach people. And if you've come this far in the video, I know you want to learn. So I'm going to keep going. Here we can see resistance became support. support became resistance, support becomes resistance, could be a breakout. Well, why is this important? Well, if you know where the market's going to turn, it makes it much easier to make money. If you buy something and it's going higher, and you say to yourself, all right, I bought it at 10, I'm going to sell it if it gets to 20, you're just guessing. If you bought something at 10 and you look on the chart and you say, oh, gee, there's a really good chance there's going to be resistance at 18, well, you would want to sell it around 18. It's not as good as selling it at 20, but it's better than having it get to 18 and then reversing and going to 17 and 16 and 15 and eventually back to where you bought it, and now you break even. You have to let the market tell you what to do. You are going to be wrong. I am going to be wrong. The greatest traders in the world are going to be wrong. The market is never wrong. Let the market tell you what to do. That's one of our principles here at Stock Market Jobber. And make sure you check out our site because I mean, this is what I do. This is what I talk about. But once again, energy ETF, resistance, support, resistance, support becomes resistance, resistance becomes support. And this is really, people take this for granted, but if you think about the size of these markets, trillions of dollars, there's really no way that a fundamental analyst or an academic could explain this. Why is it the same exact valuation here as here? Why did it lose more than 15% of its value here and then come right back up? Has nothing to do with COVID, has nothing to do with Ukraine, has nothing to do with this, that, or the other thing. It's investor perceptions that are driving it. All right? So you have to understand that the market is not a chess game. In chess, the rules are always the same. The market is more like a poker game. There are rules and there are strategies, but every time you buy or sell a stock, there's someone on the other side of the trade who thinks you're a complete idiot. If they're selling you the stock, they think it's going to go down. And you might think the same thing. Oh, this person's selling me the stock and I'm buying it. It's going to go up. They're an idiot. And vice versa. So in poker, there's another person on the other side of the table. And as like you, they're a human. At least I hope like you. They're a human. At least I hope you're human. And they have emotions. And emotions make people make decisions. As we've seen, buyer's remorse can turn support into resistance. Seller's remorse can turn resistance into support. Here we have our utility sector, resistance, support, support, resistance. And this is a good way to get trading ideas. Like if you see a sector that's really overbought, we're looking at these sectors now. These are ETFs that are called spiders, and they track the sectors. Spider is an S&P depository receipt. S&P is a big company. I'm sure you've heard of it before. Fortunately, they put out these ETFs that track the sectors. Makes our life much easier. Here, once again, real estate. Resistance becomes support, support becomes resistance, support becomes resistance. Now, you can get trading ideas from this stuff, right? If you see a sector that's really oversold and at support, well, this sector ETF that we're looking at is an aggregate of that sector. Therefore, within the sector, by definition, there's going to be things that are more oversold, that look more ready to bounce, and ones that look less ready to bounce. So if we delve into the sector and we look through the stocks that are there, and I have countless lessons on this, please make sure you check it out, then you can really get some good trading ideas. So once again, everybody, just remember, levels are important, and let the market tell you what to do because it's never wrong. Okay, thanks everyone. Hope to see you soon. Thanks for checking out tonight's market overview.